Good morning, everyone. You got John Hopkins here. I want to welcome you to our first Inside the Earnings Beats webinar war room. Something that Tom was discussing the last couple of days. Thought it was very timely. We got a great crowd in here today. We appreciate you taking the time to stop in. Just a couple of just quick ground rules here. First of all, this will be recorded, the session. All of our webinars are recorded. And once the webinar recording is complete, we'll get it out to everybody and let you know when it's available for viewing. This is the first one of these that we've done, so I know Tom is, got his outline and going to figure out, a cadence to the whole thing. But I also want to mention that we wanted to open this very first one to the Earnings Beats community. This is everybody, our subscribing members, our Earnings Beats Digest members, people who follow Tom at stockcharts.com. We want everybody to get a sense of what this will be like. Starting next week, it's going to become a members-only event because it's time-consuming, a lot of value, and it'll be open to subscribing members, including anybody who's on trial. And if you go to our website and you click on our service, it will tell you everything that comes with a membership, and you can sign up for the 30 days for no cost. It's a $7 charge, but you get the $7 back. So if you sign up for the 30-day trial, you'll get the next 4 of these over the next month, which is not, I think, I have to call it a pretty good deal. Plus everything else that we offer. So just, give it a shot if you're not already a member. And I think you're going to be pleased with what you see. The Q&A sometimes can become, really extend these things a lot. So Tom won't be answering questions during the session. I always keep an eye on the questions, and if I can answer one, I will. If there's time at the end, we'll try to answer questions, but you can always send us an email. You can go right to our Contact Us section on the site, and we'll get back to you. Anyways, I know you're here for the meat of the event, so let's go ahead and bring Tom in. Good morning, Tom.
Hey, good morning, John. Good morning, everybody.
I was thinking.
Yeah.
I was thinking a month ago how every Thursday morning they come out with the jobless claims, and you wonder if it'd go from 212,000 to 218 or 209 or 243. You'd never envision you see 6 million. It's you can't even fathom that, right? A month ago you could not fathom that. And then in the jobs report, they always had a panel on CNBC guessing 150, 200, added, not thinking 700,000, which probably will pale, compared to next month's. But anyways, these are the kind of eye-popping things that we're facing, and maybe a good way for you to kick things off here.
Yeah, I mean, I was saying earlier this morning, if you had told me back with the market we had back in January into February that we would be looking at numbers, initial jobless claims, I think last week, the first really big, well, we've had 3 now. The first one was like 700,000, I think, which was a pretty big eye-opening number. And then last week, it was revised to 3.3 million. And then this week was 6.6 million. Those numbers, if you had told, and the jobs, today they, minus 700,000.
Yeah.
If you had told me that 2 months ago, or that you tried to bet me, and what kind of odds I would have given you, it would have been outrageous.
Everything you own, be gone.
I mean, the odds of that happening would have been higher than my Redskins winning the Super Bowl.
Oh, okay.
That shows you how high those odds have been.
I'll let you take it away, my friend.
Yeah, let's get into this. First, I just want to thank everybody for joining. When I left Stock Charts back in August of last year and decided to rejoin Earnings Beats, where John and I have been partners since 2004, I really envisioned an educational environment where we bring a community of traders and investors together, and really from all walks of life. I mean, I felt like we had a service that would appeal to professionals, those who manage money. I think we have a service that would appeal to day traders, position swing traders, 401k investors, retirees, and honestly, one group that we probably aren't represented by very much, but I would love to be more represented, and this maybe is an invitation for all of you out there to invite your kids and your grandkids. I would love to be able to help educate a lot of our younger generation about the stock market. I mean, one of the exciting things about me coming back to Earnings Beats is that my daughter is now working here. And, I'm able to hopefully impart some knowledge on the market, and so that she understands things a lot better from a financial perspective as she gets older. Because if I could have gone back and taught myself things back when I was in my 20s, oh my gosh, I just can't even imagine where I'd be today. I really can't imagine where all of us are today, to be honest, kind of sequestered in our homes, social distancing, stay-at-home orders, and so forth. So the timing of all this is great. I wasn't expecting it to kind of play out the way it did when I came back to Earnings Beats. I wasn't thinking we'd be here 6 months later, really discouraged from going outside. But I'm thankful that we have the technology and that we have the community that we've built so that we can talk about some positives out there. I mean, I know the market's been horrible. Everything we read, we see from a healthcare perspective and financial perspective, it's all negative. So I'm hoping that maybe these sessions, and like John mentioned, we're going to start doing these on Friday. I think it's just an opportunity. We can look at the market right now. There's not anything I can do about the healthcare problem, and we have to rely on our healthcare professionals, which, by the way, if any of you are involved in healthcare, I want to thank you from the bottom of my heart for all that you're doing. All of our healthcare professionals around the globe. If we think it's stressful for some of us staying at home, just imagine what a lot of the healthcare professionals doing. These are the real heroes in all of this. So I want to thank everybody for their healthcare service. And I know it's probably not easy to go into work every day. Okay, so having said all this, this is an opportunity for us. We could sit back and we could take this one of two ways. We could put our head in the sand and say, I don't want to look at my statements. The market's fixed. It's rigged. It's bound to take us all down. We could take that approach, or we could take the approach of, you know what, this is creating a lot of opportunities. If we look back at all of the panicked lows in market history, and I want to give you some perspective. Let me, maybe before I give you the perspective, I'm going to pull up. Let's see if this works.
Yep.
So is it showing?
Special inside the EB War Room.
Okay. Okay, perfect. All right, so this is what I want to go over today. So, just a brief introduction that John gave you and I gave you. Again, just want to thank everybody for being here. And then this is what we want to go over today. I want to first talk about perspective, because if I was talking to my 25-year-old self, this is the first thing that I would bring up. You have to understand perspective in the market. The stock market doesn't go up every day, and we're going to have fearful periods, and it's okay because we're going to get through it. We've got a history of getting through it. We have a history of marking major lows and then rallying off of them. And so if you're thinking about this and you're saying, my gosh, the stock market's going to zero. Well, I can promise you, if the stock market goes to zero, there's going to be nowhere to turn. Everything's going to collapse. And I'm not going to live my life thinking that everything's going to collapse. I mean, that's just not useful. It hasn't done it to date, and we've gone through a lot of things. We had a pandemic 100 years ago. We had the stock market crash back in the 1930s. We had world wars that we had to get through. We had, the oil embargo and all of that back in the 1970s. We had the 1987 market crash. We've had, the 2000 dot-com bubble. We've had the financial crisis back in 2008. And 2 months ago, or month and a half ago, we were at an all-time high. We got through all of it. And as bad as it is right now, we're going to get through it. We're going to come out on the other side. The one thing I'm really thankful about when I look at the market and the fact that this all hit now, can you imagine if this had hit back when our financial system was stressed in 2008? I mean, we've had an opportunity to recapitalize the banks, and we've had an opportunity to have a very strong economy for a period of time. So we're being hit by this with probably, if not the strongest economy we've seen in my lifetime, certainly one of the strongest economies, which is a blessing. I can't even imagine with all of the trouble that we had from the subprime era, you know, and all of that impact all the way through our financial system, banks beginning to fail, you know, Bear Stearns, Lehman Brothers, all of this hitting. Can you imagine throwing a pandemic on top of that? So, you know, maybe, you know, to that extent, we should be counting our blessings that at least we went into this with a very strong economy. And I believe we're going to come out of it with a strong economy. That's my opinion. We will never in our lifetimes probably see the amount of stimulus that the government is going to throw over the course of the next, you know, 3-6 months to maybe a year, maybe more. We are never going to see the Federal Reserve pull out all the stops like it's going to pull out. And you might sit back and say, well, you know, they shouldn't do that. That's manipulation. That's, you know, you're manipulating the markets. No, they're actually doing their job. This is what they should be doing when the economy gets hit like this. And there's an old saying on Wall Street that you don't fight the Fed. I believe once we get beyond the initial shock of this, I don't know if we're there yet. I don't know if that first low did it. We'll have to see. But it's very possible that first low did it. We may not go back down below that low. I mean, I think, again, if we take a look at what's going on in the market just today, you know, with those horrible numbers, the NASDAQ's up 7 right now. The S&P 500's up 1. The Dow's down 35. The market is handling the news. It's, you know, we've already, and you say, well, you know, it's so much bad news coming. The stock market lost trillions of dollars of value since February 24, well, February 21st, 19th, whatever the high was. The market's already priced in a lot of that. Now, if you think that the market should lose 2/3 of its value, then, you know, maybe there's a debate to be had. I think losing 1/3 of the value of all the public companies in the stock market in a 6-week period is pretty dramatic. And we haven't seen, even 2008, we didn't go down that fast at any point during the financial crisis. 1987, we went down 25% in one day. But if you look over the course of 6 weeks, this actually is even worse than 1987 was. So the market's pricing in a lot of bad stuff. And we're going to continue to see bad reports. But don't be shocked if the market takes this bad news and starts to run with it, especially if we begin to see some kind of a light at the end of the tunnel from a health perspective. And that's going to be the key. I mean, the market's not going to wait for that news to come out and wait for the vaccine and then, oh, by the way, everybody, we've got a bottom now. So go ahead and buy, get in, and then we'll start. But that's not the way the market works. The market, you know, you got to have some belief in our future. And you've got to take advantage of these moves to the downside when they're there. Because what inevitably happens is you wait and you wait and you wait, and the market goes up and goes up and goes up. And then you say, well, I can't get in now because it was way down there. I want to wait until it goes back down there again. But if you go back and look at history, it doesn't go back down there again. Once that bottom is set, it is set. And when it's set with a volatility index reading in the 80s, that is extreme pessimism. We hit 90 intraday or 89 and change intraday back in 2008. But that's not the norm. I mean, these are extreme readings. When you see a market bottom or move down on this kind of reading, you know, it's very possible that our bottom is in. So anyway, I'm going to give you a perspective on the 100-year chart in a minute. We're going to talk about that fear, the VIX and the equity-only put-call ratio, because I think these are the two big sentiment things that I like to look at. Then we're going to get into the comparisons, 2008, 1987, Fibonacci. When we get into a market like this where we've got panic selling, impulsive bouts of selling to the downside, the VIX, the equity-only put-call ratio, and the Fibonacci, to me, become much more important than the PPO and stochastics and RSI. It's just we're in a different environment. We're in an environment that is being directed by sentiment, by extreme fear. It's not being directed by historical price action, which is what PPO and RSI and stochastics are based off of, or any other, for the most part, any other technical indicators that you use. When we get into a fearful market, technical indicators, honestly, you can just about throw them out the window. They just don't work. You see price support levels and the market goes straight through it like it never even saw it. I mean, that's, if you go back and look at the chart, I mean, tell me I'm wrong. The S&P 500, 3,400, 6 weeks ago. How many support levels did we go through without nary a bounce? I mean, we had a one-day hop here and one day there, but for the most part, we went straight down for, well, from the 19th to March 23rd, 5 weeks. It was a straight drop, ignoring all price support along the way, ignoring your PPO center line, ignoring, you know, when you hit your trigger line, no bounces off the trigger line, ignoring your RSI 40 support, ignoring, you know, stochastics. Maybe you were looking for stochastics to hold at 20. None of that mattered. Stock market just sold off. And that's what happens when everyone panics and literally throws the kitchen sink in. Then we're going to get into this is understanding the AD line and its signal. I've changed my strategy. You know, I look at the market and you go back throughout 2019 into early 2020, I've been extremely bullish. Every one of these pullbacks that have come back, I've been bullish. And I think when we moved to all-time highs, I think that that confirmed that my belief was correct. Now, it's really hard on the charts to try to interpret price action to tell us that a pandemic is about to hit what we've seen here over the last 30 days. I don't think anybody could have predicted. I mean, we knew it was out there. We knew it was bad in China, but you know, there was all these varying reports as to how it's going to impact us and whether or not it's going to be bad. And, you know, you just have these things evolve. And so the market has evolved with it as things have continued to increase exponentially. Stock market increased to the downside exponentially as well. You just can't predict something like a pandemic on the charts. However, what you can do as a technician is adjust on the fly. And that's literally what we've been doing in earnings beats for the last 30 to 60 days, is we've been adjusting on the fly. Right now, earnings reports, in my opinion, don't matter. If a company can come out with strong earnings and say, hey, you know, this environment actually benefits our business, and there are some of those, then yeah, I think companies that can show that, hey, our earnings are going to grow as a result of all this, I think those are obviously going to be companies that are going to see tremendous valuations relative to other companies that are obviously being impacted negatively by the coronavirus and the stay-at-home, social distancing, all of this stuff. But there are companies that are going to benefit from it, not just in the short term, but also with a paradigm shift. You know, working from home has kind of been a luxury, and maybe a few more companies over the years have kind of adopted it. I think this could actually, you know, when companies are forced to adopt it and then they begin to see the benefits of it, I think this could change really the landscape of business as we go forward. There's still going to be a lot of brick and mortar companies, but this is going to, you're going to have a lot of workers that are going to be home with their kids, and they're going to realize, you know what, if I could do this all the time, I wouldn't have to pay for childcare. I'd be able to spend more time with my kids. You know, so there are obviously a lot of benefits from it. So we have to keep all of that in mind. But as I get back to this outline, understanding the AD line and its signal, I think this is one of the changes that I think for me has come out of all of this over the past 6 weeks. And I'm going to explain why in just a little bit. New and improved Strong Earnings ChartList. I actually updated it. It's not ready to be sent out yesterday or today or yesterday. I finished it yesterday. But what I've done is I've gone in and I've now added the accumulation distribution lines and any stocks that are on that Strong Earnings chart list. And we had like 380 of them. They've been weeded out. I've just deleted them because everything's changed. I mean, it doesn't matter if a company had great quarterly earnings last quarter and management was on top of things, because just like I said, you can't predict a pandemic. A pandemic really changes the landscape for everybody. It's a do-over to go back and look at what's going on to try and figure out, okay, where do we need to be? What do we want to avoid? What do we want to focus on? And so, and if you're, like to short, there's opportunities on the short side. If you like to be long, I think there are tremendous opportunities building right now on the long side. And we're going to go through some of that in a bit. But I want to go over that AD line and its signal and compare it to OBV, and I'll show you a few things with that. As far as the strong earnings chart list, again, I weeded out the weak AD lines. So that chart list, which used to have maybe 380 charts on it, I want to say, I can't remember now if it's like 130 or 150, but probably 2/3 of that strong earnings chart list has now been deleted. And I'll be getting that out to everyone. If you're new to Invested Central and you're not currently a member, if you do take us up on that $7 trial, if you're a member at Stock Charts and you're also a member at Earnings Beats, we'll send you a link where you can download this chart list into your account. And you'll see it. I'll go through these and show you a little bit about it, and you can see if you're interested. Then we'll go into where to trade. I mean, this is where I've been focusing most of my time over the last 6 weeks. And if you don't know it, my background, I passed CPA exam back in the mid-'80s. I was in public accounting for 20 years. I love to analyze. I mean, I don't care if it's a printer, a manufacturer, a banker, a law firm. When I would go out and I would audit, I really like to dig into the numbers to find concrete things to point out to management or the owners to help them improve their business. And when I look at the stock market, I like doing the same thing. It's easy for me to write something and say, hey, the S&P 500 is down 25% or 35%. Well, anybody can see that. They look at the chart. But what doesn't show up necessarily on the charts is where the money is rotating. So yes, the S&P is down 35%, but what are the airlines doing? The airlines are down, 60%. What's broadline retail doing? Well, broadline retail is only down 15%. Well, that's telling us something. That's telling us that, yes, the S&P is down 35%, but there's a lot of rotation going on in the market. And there's a lot of people in the market that are buying, millions of shares who are a lot smarter and have access to a lot more information than you and me. And I like to think I'm smart, but I don't have all the data. I don't have all the experts that I can draw on that many of these Wall Street firms have. They have top economists. They do all this research. They have all these research teams, hundreds of people that go out and research these companies and find out which ones are poised to do this versus that. When you follow the charts and you follow relative strength, it all comes together. And it's almost like all these people, all these brilliant people are working for you. They're pointing out to you what is taking place in the market so you can position going forward. And then finally, last thing, trading strategies. So I've actually moved to doing almost no trading. I think it was back on February 26th, something like that. I've got a screenshot I'll show you in a minute. But I sent out in my daily market report back in late February, I told folks, hey, the volatility index has climbed above a certain level. When it gets above 20, I really hunker down. I don't trade much. I would rather sit in cash. Now, sometimes you get a VIX that goes into 20s, and that marks a short-term bottom in an uptrend. And that's fine. If I miss the bottom, we come back up, and then I trade in a better environment, that's good. I'm okay with that. But what I don't want to do is hold on when that VIX goes from 20 to 50, because that's where the major damage is done. Or when VIX goes into the 80s, we've seen what happens. If you're sitting on the sidelines through most of that move to the downside, you've obviously got a lot more purchasing power, and you can analyze what's being rewarded in the market, what's not, and start repositioning your portfolio. And so that's the whole idea for me, is understanding the risks that increase when the volatility index goes higher and reaches certain levels. And when it does, I know from history that this is not the best environment to trade. Now, some would argue, some would say, well, my gosh, you missed this 30% move or 40% move in the airlines recently. Well, yeah, but I avoided the 80% or 70% decline on the way down. How do you know when the exact bottom is? I mean, I would have thought 20% down in the airlines would have been a big number. But it turns out, some of these groups, airlines, cruise lines, and some of these others that have been hit so hard, recreational services, they've gone down not 20% or 30%, but 60, 70, 80%. And so trying to figure out when that real bottom occurs and then having only 2 or 3 days to benefit from it is really difficult. That's a hard concept to master. I mean, if you can do it, congratulations. I think that's awesome. Yes, you can make a lot of money. But if you find that you chase moves and you wait and you see the stocks move for 2 or 3 days and you're like, oh, bottom's in, let me jump in. 2 or 3 days later, you're back down 25%. And now emotions creep into your decisions. And so that is why, number one, I don't trade much. And when I do trade, I trade much smaller positions than I normally would. Because if I'm right, I can make some pretty good money. I mean, I can get a 10% move in a day or two. That's just the way this market is set up. But I also can lose 10% in a day or two, unless I have my stops in tight, which I try to do. But at no point in the last 4 weeks would I say that I have had more than 50% of my portfolio invested. And for a little while, I actually was starting to build some ETFs up. And then once we broke back down again, I ended up getting stopped out of those. But right now, in terms of trading individual stocks, if I have 20 to 30% of my portfolio invested, that's a lot, because I just don't want to take the chance. I want to get a market where the VIX is back down and below 20, 25. Let me see it really start to pull back. And then I think things become a little bit less risky, and I can start looking for my leaders again and begin to trade the way I normally do. So right now, my trading strategy is I'm just trying to develop a bridge from where we are now to where we are when we have a much better stock market to trade. And if I lose a little bit, that's fine, but I want to try to keep as much of my capital intact as possible. All right, I'm going to get out of this presentation. I want to start showing you some charts. All right, so I started and said that perspective. And by the way, this webinar is we're calling it our war room, webinar room, get it, W and then AR at the end. But really what we have is a battle going on financially with everything that's taking place with the coronavirus. So, I feel like what we want to do is use this opportunity on Fridays to inform, educate, talk a little bit about trading strategies that you might consider. I mean, if you already have your own trading style, I'm not saying, hey, switch it to what I'm doing, but you might pick up some things that maybe you could add to make your trading, decisions even better. Or maybe it gives you a little bit more confidence in some of your trades. So maybe instead of getting whipsawed out of one, maybe you hold it a little bit longer because something you pick up in this webinar tells you that, hey, maybe I need to stay the course just a little bit longer. Maybe you get that reversal and cuts down on some of your whipsaw trading. Whatever it is, I hope that this session helps. I expect we're going to go probably until noon, which is another hour and a half. Got a number of things I want to cover. If you need to go, feel free, head out. We are recording this, assuming that we don't have any technical problems with Zoom, because they're getting a lot more activity. And so we have run into one instance where we were put on hold for quite a while to get a recording done. But, assuming that everything's normal, we should have a recording out later today. And we do want to share that with our community. But going forward, these sessions are going to be for our members. Just want to point that out. So if you like it, we have a 30-day, as John mentioned, 30-day, fully refundable $7 trial. So you pay your $7, you get it back within a couple business days, and you have no obligation for 30 days. You can try this out, and hopefully we can help you, walk you through a lot of what's going on, and maybe help in some way. All right, let's take a look at from a perspective, a 100-year chart. This is perspective. I have said recently, and I am sticking to my guns, that I believe we remain in a secular bull market. And when I talk about the accumulation distribution in a bit, you'll maybe understand why I believe we are getting a confirming signal that we remain in a secular bull market. Short term, could we go back down a little bit lower? Sure. But when you look at this 100-year chart, you start to put this drop in perspective. Yes, it's been horrible. It's one of the worst drops we've ever seen in a 6-week period. But it's also when you look at it in perspective, it happens. These things do happen. Here's the 1987 crash, by the way. Now, if you had in that crash said, that's it, I am done, the market's going to zero, I'm getting out. Well, if you had gotten out, you'd have gotten out right at the low that was never revisited again, and you would have gotten out in the middle of a 20-year secular bull market. From 220, whatever that low was back in 1987, 13 years later, the S&P was up 7 times. Think about that for a second. 13 years later, you'd have had 7 times your money. Now, you might be sitting back and saying, well, I'm going to be retiring, or I'm retired, but I need some of this money in 10 or 10, 12 years, 13 years. Well, historically, if I didn't need money for 15 years or 13 years, I would leave my money sitting right here in the stock market. When you look historically, maybe 1930, maybe some of you are saying, well, this is 1930s all over again. This is a Great Depression coming. Well, if that is true, then yes, you probably have an opportunity to get out now and save a lot of money. That was a one-time thing. Could it happen again? Sure, anything can happen. I mean, maybe we're going to go down to 200 on the S&P 500. If we do, we're going to have a lot of problems. I don't see that. I just don't see it. I think our economy was strong. I think we will have the fiscal stimulus, the Federal Reserve behind us, and I think jobs will come back just as fast as they left us when we get to the other side. And I think the market's already priced in a lot of negativity. But again, maybe we go a little lower. I don't know. But again, perspective, 1950s and 1960s, we had a secular bull market. We had multiple recessions, and we had multiple cyclical bear markets within a secular bull market. Secular means long-term. Cyclical means short-term. So short-term 20% decline is a cyclical bear market. When you're in the midst of a longer-term push to the upside, that's a secular bull market. Now, we have a history of going sideways, exploding, going sideways, exploding, going sideways, exploding. That's our history. That's our economic cycle. We go through periods, over regulation, under regulation. When you're not regulating, things can kind of take off, and then you start regulating too much and you constrict the growth. These are cycles that play out over and over again throughout history. I believe we're in one of these cycles. When we broke out above this double top, it was 2013. When we have done that in the past, when we've made that breakout, and I'm going to look at this double top right here, made that breakout in 51, we went for 2 decades to the upside. Made this breakout in 1981, 2 decades to the upside. Made this breakout in 2013, I'm thinking 2 decades to the upside. That would take us into the 2030s. Now, we're going to have these red circles. We're going to have these cyclical bear markets. I think that's what we're seeing right now. And again, I think we come out of it, move higher. So again, take what you want from this chart. I just want to make sure everyone understands that there is some perspective here on what's taking place and the opportunities that this could present if it looks anything like these prior cyclical bear markets. We come out of them very quickly, very strongly, and there could be some tremendous opportunities ahead. So I know we're all focusing on the news now and what's hitting us right now, but I think if you turn your attention to what could be happening 3-6 months out, maybe a year from now, I think you'll see that there are a tremendous amount of opportunities in the market here. All right, next up, let's look at the fear, because we are definitely in a fear-driven market. Forget about technicals right now. I'm watching the VIX. I'm watching the equity-only put-call ratio. Here's a 5-day moving average of the equity-only put-call ratio, and this is just going back the last 5 years. But you can see these spikes, 105, 5-day moving average of the equity-only put-call ratio. When this number's rising, it means market's fearful, and everybody's betting in the options world that the market's going to go down. And we know what happens when the masses get on one side of the trade. It turns. We go the other way because human emotion is just so typical. Market pulls back a little bit, it's okay. I'm in it for the long haul. This is just a pullback. Pulls back a little bit more. Well, that's all right. I've decided I'm in it for the long haul. This isn't anything bad. If I hang in there for another 6 months, it will be beyond all this. Not a big deal. Get another pullback. Then you start thinking, well, how bad is this going to get? I haven't sold. I should have sold. Maybe if it gets back up to where it was last month, I'll sell. Then it goes down another 10%. Then all of a sudden you're like, wow, now my account's really getting hit. And so the human emotion starts to take a toll on you as you go to extremes, one way or the other. It can be bullish, it can be bearish. And so when technicals no longer work and we start falling behind or below major support levels, trend lines, and so forth, and the volatility index and the equity only put call ratio start showing the fear building and building, that's when we have huge impulsive bouts of selling. And market makers, they're the guys that provide, guys that provide liquidity in our market. They go on vacation. It's like when everybody wants to sell and there's panic in the streets, you know, if everybody's going to sell, would you want to commit your capital to buy, to let everybody else out? Of course not. You're going to jump on the bandwagon. Market makers, they're traders. They're going to short too. So now we got everybody shorting, everybody selling. And when everybody's selling and few people are buying, that's when you have these moves to the downside. They are not technically driven. There are very few technical buyers. And if there are technical buyers, they're swamped by folks that are selling out of panic. And so, you know, you think, oh, I'm just going to buy in here. This is a good place to buy. Or you get the move down and then you start to rally and you chase the rally. And then the next thing you move down again and you're like, wow, I'm going to add to this position. And you know how the whole game works. Another few weeks, you're depressed and you don't want to open your monthly statement. Well, I take a different approach. When I see the fear start building and reach certain levels, I don't want anything to do with the stock market. I just want to sit in the sidelines and just wait. I like to wait it out, maybe try and pick some spots, try to figure out, analyze the market, figure out what's going on and see if I can find some opportunities and, you know, find a little niche or a little something that maybe a lot of other people aren't seeing and use that to my advantage, take advantage of it. But here you can see the equity only put call ratio, March 23rd, or right around that time, the 5-day moving average of the equity only put call ratio hit 105. Now I'm going to stretch this back. This is 5 years. Let's go back 15 years. 105, all the way back. Here's 2008, the financial crisis. We got up to about 103. So we got to that extreme. When we get to these lows, now here in 2008, we did print one more low. But if you had hit that first low in October, yeah, you probably would have been panicking in March when we went to a new low. But again, using perspective, would you have cared if you bought in October of 2008 or November of 2008 versus March of 2009 with where we are now or where we've been at any point in the last 12 years? Probably not. That would have been a pretty good time to buy. We're there again. And I know we all want to say, well, this time's different. This time it's going to zero. This time is the Great Depression. This time, well, there's a lot of this times that never panned out. So again, be thinking about this fear and this panic as creating opportunities. Volatility index. Here's the deal with the volatility index. The beauty of the volatility index is the calculation is it's really expected volatility. That's what the volatility index, the value that's assigned, is it's the expected volatility over the next 30 days. It's not telling you what happened last 30 days. It's telling you what it expects the next 30 days based on the pricing of short-term options. So just talked about the equity-only put-call ratio. As prices start to move more and more wildly, option prices, if you trade options, you know the premiums start to move up and well, they move up. You have to pay a lot more premium over and above. You know, if you're buying a option on Apple for $250 strike price, and you're buying it for next month. Well, if Apple doesn't move much, if it's been trading between 249 and 251 for a month, you're not really going to pay too much for that call option on Apple to go much above $250. But what if Apple in the last 30 days has traded from $210 to $290? And now you've got an opportunity to buy an option to own Apple at a $250 strike price. You're going to have to pay a lot more premium because the chances of you making a lot of money on that are great because of the huge volatility. That's what the VIX does. The VIX prices in the cumulative. It really looks at the S&P, but it's basically pricing in that cumulative look ahead of what it's forecasting. So when the VIX is rising, it's telling us that the market is anticipating more volatility ahead. And when you go back through history, more volatility equals more selling. That's what volatility is. So when I see the VIX on a daily basis get up to 20, I get nervous. When I see it going through 20, when it gets 25, 30, 35, 40, 40, I mean, you can imagine how nervous I'm getting. And as that happens, that's when the market is selling off. That's when the real selling kicks in. If you catch it early, you don't really lose that much. If you hold while the VIX keeps going up, that's when the impulsive selling kicks in. Market makers go on vacation, and it's like, a matador, just kind of waving at stock prices as they go flying by, just like with the bull. Instead, in this case, it's the bear. But that's why the volatility index is important to me. Now, this chart right here goes back to 1996, and this is a 5-day average of the VIX, okay? So this is telling us that when we see a reading at 20, that means that we've already had 5 days that when you average them together, simple moving average. So maybe we have 18, 19, 20, 21, 22. 5 days in a row with the VIX at those readings, your average would be 20. If you go back and look at history, sometimes these trips to 20, like right here in the third quarter of 2019, this little low right here, you get up to 20 and it marks a bottom. Over here, 2025 is a pretty good level of volatility. That normally will mark, key bottoms in an uptrend. But when you start losing major price support and that VIX goes through 20, I'm not going to sit there and say, well, maybe we're going to reverse, or I think we could reverse. So let me go all in. Let me go out on margin, because we don't know if that VIX is going to top at 20, or if it's going to top at 30, or if it's going to top at 40, or if it's going to top at 70 or 75. This is a 5-day. We went all the way to 75 this time. So if I was jumping in at 20, I mean, that's fine. Jumping in at 20 is fine, because a lot of times we do reverse, but you better have your stops in play. Because if we keep going through 20 and we go to 70 like we did here, look at what happens to the market. That's why, for me, I want to be cautious, move to the sidelines. It's an easy choice for me. And if it hits 20 and the VIX goes back down and the market goes up, fine. If I miss a little bit of upside, that beats the heck out of being on the side or being in the market when it gets absolutely pummeled. I'd rather miss out on 2 or 3, 4% to the upside than to hold for 25% to the downside. It just doesn't make sense. So there are certain fear parameters that once we hit, I don't take any chances in the market. And let me see if I have another something here that I wanted to show you if I can find it. If your screen's gone blank, just bear with me. Well, I may not be able to. What I was going to show you, and you could go back into our website and scroll back through the daily market reports, but it was back on, I think, February 26th or 27th that I wrote to our members, and I said, the VIX is moving above 20. This is the kind of environment where cash is king. And I said at that point, I was not planning to do a whole lot of trading going forward when the VIX hits that level. So this isn't me telling you that, oh, a month ago, this was your signal. That it was a month ago or 5 weeks ago that we were already talking about it. Now, and this is coming from somebody who is very bullish on the market. I'm not a perma bull. I mean, I am long-term right now. I still believe we're in a secular bull market. And I recognize the secular bear market that we were in from 2000 to 2012. But when we broke out in 2013, that was a major change in the landscape for U.S. equities. And I believe we're still in that landscape, even though we've got this coronavirus, this pandemic, this huge drop in the market to deal with short term. I really believe that if we just had, binoculars or an X-ray machine, we could look out into the future. I think we would see a market that looks a lot different a year from now than what it looks like now. Just my opinion. Take it for what it's worth. But again, fear. This is, and I'm continuing to watch this. I love that it's coming down. The VIX 5-day moving average is coming down. The equity only put call ratio coming back down into a area of neutrality, which is good. But we've got a lot of work still to do the upside. And the other thing that I want to talk about when we get into fear-driven markets like this is Fibonacci, because this is about the only time I like to use Fibonacci. I'm not a real big fan of Fibonacci, but I think when you get these impulsive bouts of selling, it's like dropping a rubber band or a rubber ball off the Empire State Building. If you drop it off the top of the building, it's going to bounce when it hits the ground, but it's not going to bounce back to the top. It's going to bounce back, a certain percentage. And if you dropped it off every time, it would probably, every time you drop it off the Empire State Building and hits the concrete, it's probably going to bounce back to about the same percentage level. That's the way I look at the Fibonacci. So when I look at this, this was an article I wrote back just a little over a week ago. Here's the 1987 market crash. So here's the top of the Empire State Building. Here's the rubber ball dropping. Here's your bounce. 38.2% didn't get through. Here's 2008 financial crisis. Here's the top of the Empire State Building. Here was that huge drop. Here was the rubber ball and bouncing. 38.2. Intraday, we got up almost 50, but that 38.2 is the level. Now we're in 2020. Here's the top of the Empire State Building. Here's that ball dropping. Here it hits the pavement. And this was back on the 24th. I was saying, okay, where might we bounce to? And there's the area that I marked for the S&P with the arrow back before we bounced. Now let's look at where we bounced. Pretty darn close to that 2650 level. I think we got within about 9 points. Now, probably a lot of people when it was 2186 didn't think that we were going to be back in a short period of time, less than a week really, back almost to that 38.2% level. This is the way the market works. The problem is knowing that this is the low, because you could have made the mistake and said, well, this is the low at 2280, and here's the bounce starting. Jump in. So you jump in at 2450 on the bounce, and then one day later, you're under 2200, and you just lost 10% of your value in one day. That's the problem with trading a market like this, is that if you're wrong and you're off by just a day, it can be painful to your balance. So yes, if you hit this perfect and you rode this up perfect, wow, you could have made a huge amount of money in a short period of time. And if your timing is that good, and this day, by the way, March 23rd, go back and look at the daily market report. I actually said that with this low, the VIX was actually not setting a new high. And so the reduction in the VIX combined with the new price low was a bullish development. Now, did I go running out in my account and jump in everything on the long side? No, I didn't. I wish I had, because I'm just a little bit scared of being in a market with a volatility index at 80. We don't get this very often. These are the numbers we don't see much during a lifetime. So yeah, I mean, get in 2200 and maybe one day later we bottom at 1900. But if I had gotten in at 2200, it's going to be painful to hold down to 1900 before we make the next bounce. And so that was the problem, is that we had all of these temporary one-day bounces. They looked great, and then we were right back down the next day. So got to pay attention to Fibonacci. I think this initial move back up, 2650 is going to be a key level. If we can get through that, then maybe 2792, getting up close to 2800 is a possibility. If we start moving above 2800, I'm going to really believe, especially with lots of bad news coming out, I'm going to believe that that bottom is confirmed. Now, what I would like to see, well, I don't want to see it go back down, because I know a lot of people still have their money involved in the market. But I'm talking about simply from a technical perspective and a fear perspective and a reward to risk entry point perspective. I would love to see the market go back down and retest. If we go back into that article and you look at 1987, here was the ball bouncing off the pavement. There's your reaction high. We didn't go all the way back down the low, but on two separate occasions, we got pretty close on a pullback. So this is maybe a lesson that if we do start pulling back and you are a little bit aggressive and you're thinking about, hey, this is a time maybe to think about getting in, you might want to start thinking about getting in as you get closer. Remember, lows that print with a VIX in the 80s, first of all, we don't see that very often. VIX doesn't go back all the way in time. I can't see what the VIX was in 1987. My guess is the VIX probably went to 50 in 1987 because it happened really fast. One day, 25% down. It wasn't building up day after day after day for 3 or 4 weeks like it did this time, or even in 1987, or excuse me, in 2008. 2008, by the way, the VIX was already elevated. We were in a bear market when the big drop occurred. So anyhow, that's all I wanted to talk about here with the comparisons in Fibonacci. Just keep an eye on that Fibonacci level. So why do I think that we're in a secular bull market still? Well, I'm going to bring up a chart here for you. And actually, I don't need to bring up a chart. I'm going to go into my article. I wrote an article this morning. Let me bring that up. It's already there. I'm going to show you first the 2020 move to the downside. Here's the spider. Now, the reason I use the spider and not the S&P 500 is that the spider it shows the true open of the S&P 500. If you look at the candlesticks on an S&P 500 chart, they won't look exactly like the spider because many stocks in the S&P, some of the larger cap stocks, don't open right at 9:30. They open at about 9:30 in 15 seconds. And so the first reading that you get on the S&P 500, many of the stocks are still showing the prior day's close. So they don't show the full extent of a gap lower. The spider, however, will show you exactly where all the companies are projected to open at the open, where they do open or where they're projected to open. So the spider is a much better indicator when you're looking at candlesticks than using the S&P. Same goes for the diamonds versus the Dow Jones. The QQQ and the NASDAQ are pretty much the same. Most of those NASDAQ companies do open right at 9:30. So the QQQ gives you a pretty good look, just as the index does. The NDX, NASDAQ 100. But here you got the S&P 500, the spider, going lower throughout, from the February 19th high all the way through the March 23rd low. Pretty easy to see. We just keep going lower. Accumulation distribution, when we first moved down here, you can see the drop. But since then, since all the way back here, we saw all of these new lows being made, but accumulation distribution never went back down and set a new low. It actually has higher lows in place with lower lows in price. On balance volume, which a lot of people look at on balance volume and accumulation distribution as kind of the same thing. And they generally are, except when you get in a really volatile environment, and then you can see some major differences. So when you're looking at it during, just a regular move to the upside, you can see accumulation distribution kind of moseying its way higher. On balance volume, a little bit behind, but basically does the same thing. Look at what's happened over the last 6 weeks. They initially both went down, but since this low, accumulation distribution going up, on balance volume keeps going down. On balance volume just simply says, did we go down from yesterday? Okay, we went down. Okay, then let's just take this volume and let's just add it in as a negative. So when you're getting massive volume and you're going down most of the days, you're going to see OBV collapse. But what we've been seeing in the market is a lot of these moves each day to the downside, we're seeing massive gap downs. And then in many instances, look at all the hollow candles. That's part of my article. I don't know. I mean, you can pull this up later and take a look at the spider, but pull up a 2-month chart and just look at the number of hollow candles. Hollow candles mean you're closing above the open. So yes, we're seeing panic and fear. Everybody's selling at the open, and then we're rallying back. Who's buying? Somebody's buying. I mean, if we were truly distributing, we would not only be moving lower at the open, but we would see tons of selling throughout the day. We're seeing that in some areas. Airlines have been sold off hard. Cruise lines have been sold off hard. I mean, there's a number of a lot of the energy area have sold off hard. If you go back and you look at accumulation distribution on many of those areas in stocks, you'll see accumulation distribution going down just like OBV. But During all of this selling, there's actually a lot of accumulation taking place in other areas that are not as heavily impacted, or that actually may even have brighter futures as a result of everything that's taking place in the market right now. And so this is the net. This is the cumulative effect of all the stocks in the S&P 500. But you've got a lot of stocks that are being accumulated while others are being tossed to the side. And that's our mission, is to separate those winners from those losers. But as you look at this chart, look at all these hollow candles where we're finishing above the open. Very few big red-filled candles. Big red-filled candles is what would drive the accumulation distribution down. Big hollow candles is what's going to drive it higher. Okay? When we were going higher in the accumulation distribution back at the end of 2019, early 2020, we had very few pullbacks. Why? Because we had very few days where we actually saw a red-filled candle. We had very few days where we saw selling during the day. As a result, we kept going higher. Well, now all this moved to the downside. If we were selling throughout the day, we would see this completely falling apart to the downside, especially with all the volume coming in. But instead, we're holding our own. And many parts of the market, this is the net. Remember, this includes areas that continue to be sold off during the day and areas that are being accumulated during the day. So the net is holding up, but imagine what the best stocks are doing. I'm going to show you some of those in a bit. So hopefully you understand a little bit the difference. I think accumulation distribution in a wildly volatile market like the one we're in right now, I think accumulation distribution is way better than on-balance volume. I don't think on-balance volume tells you the whole story. In my article today, I gave an example of, let's say the spider is at 300 close one day. Pick one of these days where we had the huge gap down and then a massive recovery. Look at the end of February here. Off of this downtrend, we had this huge gap down and then massive rally. We closed right on the high of the day. Very, very heavy volume. That, to me, is not selling. That's an opening gap down. Fear, you and me going at the open saying, I can't take this pain anymore. My gosh, 5 days in a row of this. I'm selling. I'm just selling everything at the open. Well, who's on the other side of that trade? If everybody's selling during the day, the market's not going to come back. Somebody's got to be buying. And that's what these hollow candles represent. Accumulation. Look at what the accumulation distribution line did that day. It came soaring back up. But we finished $1 below the prior low, close. $1 below the close. So how does the OBV handle this kind of heavy volume move? With a massive continuing move to the downside. So you got to look at these two indicators and say, is this a bullish candle or is that a bearish candle? And for me, there's a lot of buying taking place. Somebody's buying. To me, it's a bullish candle. Now, does that mean that we can't go lower? No. But what it does mean to me is that as we go through all of this, that we are finding buyers to accumulate. I believe Wall Street is accumulating while all the smaller investors panic out of their investments. And then we're all going to be faced, just like we were back in 2009, 10, 11, with wondering what to do as the market rallies back. And you're so shaken from what you went through in the financial crisis. And then you're going to say, well, you know what? This rally is not for real. It's QE. Quantitative easing, the Fed's, manipulating the markets. Well, from that point, 2013, 14, we kept going higher and higher and higher. And that's what I believe we're going to all be facing 6 months, 9 months, maybe even 1 month. I have no idea how long we're going to stay down. If we get any positive news from a health perspective, I think the market is going to skyrocket. I wouldn't be surprised to see all of the triggers or all of the, what am I trying to think of, the mechanisms for the market at 7%, 13%, where we have to stop trading for 15 minutes. I expect they're all going to get triggered on a day when we have some good health news. I wouldn't be surprised to see the Dow open a 7% trigger. 15 minutes later, 13% trigger, 20% close for the day. That wouldn't shock me if we have some good news that comes out. The other thing is that while everybody is selling and going lower, I cannot begin to tell you how many shares short are out there. When we start going up, those who are caught on the short side are going to be seeing the short squeeze of a lifetime. So I would just, I'm not necessarily disagreeing with shorting in this market environment. Just make sure you keep your stops in play, just like if you're on the long side, no different. When this market is finally ready to start moving to the upside, I think it's going to surprise a little. It's going to surprise a lot of people how fast it will move back up. I mean, we've seen a little taste of that, but I think we still have a lot. We still have a lot of pain and volatility and things ahead of us. Again, I think we'll probably go back and retest, maybe even put in a lower low. But I really believe that during this process, especially if what I'm seeing continues, the accumulation that I'm seeing continues, I think this market's going to explode back to the upside in time. Now, this is the technical way of looking at accumulation. I'm going to show you the geek's way. That's the geek, G-E-E-K. That's what I am. I'm a former practicing CPA, love spreadsheets. When I do analysis, sometimes I do analysis on charts, but a lot of times I do analysis by simply rolling up my sleeves and putting in data into a spreadsheet and analyzing it. And so I want to show you another way of looking at this S&P 500 decline and where we are today. This is going to probably blow your mind if you didn't read my article earlier, if you haven't seen me do this before. I am going to share this spreadsheet. Can you see it, John? Aaron, somebody? Just let me know.
Yep.
Okay. All right, so this is the spider, and instead of looking at the chart from February 19th to April 2nd, which is what we were just looking at, let's look at the spreadsheet for a minute. Now, what I've done is I've gone in here and I've put in the closing price every day. This is a column of closing prices for the spider. Every day, February 19th to April 2nd. Then I put in the opening price over in this column and the closing price that day, opening price next day, closing price that day, opening price next, and so on, all the way through. And I've calculated the gap. So from the closing price on the 19th to the opening price on the 20th, there's the gap. The intraday swing is what happened from the opening price to the closing price. So I did this for each day. It's all laid out there for you. And then I went back and did another study and I said, okay, well, what would happen if, knowing, and I'm going to go all the way down here to the bottom first. So here's the net gaps. The spider has gone down $84 from the February 19th close at 336 to the April 2nd close of 251. That's $84.53. So if you just bought the spider February 19th and held it till now, you'd have lost $84.53 divided by that. That's probably about 25, 26, 27%, something like that. That's what you would be down. But in my analysis, what I realized is that if you add up all of the opening gaps since February 19th, the spider's gapped down $95. But wait, it's only down 84, but it's gone down 95 during the day, or excuse me, at the open. That means that during the trading day, on a net basis, since February 19th, the spider has risen $10.94. And so then I just decided, okay, let's put dollars into this. Let's say that back on February 19th, you had a, X-ray vision. You knew what was coming. And you knew it was just going to be fear and everybody selling at the open. And you knew that Wall Street was going to accumulate. And so you said, I want to develop this strategy. I'm just going to invest $100,000 starting on February 20th at the open. I'm going to buy the spider at the opening bell. So I'm going to take my $100,000 divided by 335.77 opening price. That's going to give me 297.82291 shares. And at the end of the day, I'm going to sell those 297.82291 shares at the closing price of $334.98, and I'm going to have an ending portfolio value of X, which in this case, $99,764.72. And I'm going to go to bed relaxed because I don't have any money in the market. And I'm going to get up the next day and I'm going to do the same thing. I'm going to reinvest that $99,000. I'm going to get in at the opening price. I'm going to get in at that opening price. That's going to give me 299.13 shares. And I'm going to hold it until the end of the day. I'm going to sell. And this is what I'm going to be left with. Now, if you did that, I'm not going to go through it every day. But if you started with $100,000 and you did this every day, you were in the market from 9:30 to 4 o'clock Eastern Standard every day. The only thing you avoided was the opening bell and all the fear that went into it. Your $100,000 back on February 20th at the open would now be worth $104,956.61. Let that sink in for a minute. The market's down 26, 27%. And if I had just avoided being in overnight, I would have made 5%. 5% in 6 weeks. That's not just a positive return. That is a heck of a return. I think there's a lot of accumulation taking place in this market. The other thing I wanted to show you is a stock, and I'm going to show you some individual stocks on charts, but I pulled up Intuitive Surgical, ISRG, and I said, this is one that shows really nice accumulation distribution. And it's in healthcare. Healthcare has been the best performing sector. So you got a good stock and a good industry group, strong accumulation distribution. And I said, wonder if I did the same $100,000 exercise, what would that have done with ISRG? And so go through the exact same process. So I'm not going to spend a lot of time here. But that 100,000, and by the way, I broke these out. March 23rd was the low of the S&P. So I wanted you to see where you would be. So let me go back to the spider and show you. During that move to the downside, from 336 to 222, that's roughly 35%. I think it was 35% that I have on my other spreadsheet. S&P, the spider, was down 35%. If you had done this strategy, at that point in time, your 100,000 would be down just under 93,000. So you'd have been down a little over 7%, while the market was down over 35%. And then during this rebound, this is when your 92,000 comes back up to 104, okay? So now let's take a look at that ISRG. Now with ISRG, starting with that opening or closing price from February 19th, here's your open. This is this is the number of shares you get, blah, 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 all the way down. Through the March 23rd close, you can see that ISRG was down from 614 to 367, which is $247. 247 divided by that's about 40%, roughly. I'm just doing this in my head real quick. But that's about 40% down on ISRG during that period. But if you didn't hold overnight and you were only getting in at the open, you'd have been down about 12.5% versus 40%. This is another way of looking at accumulation distribution. So yes, we were going down, but there's still a lot of folks that are buying during the day. And when we look beyond March 23rd and we look at the recovery, that 87,000 grew back to 118,000. So over this 6-week period, if you invested in ISRG at the open, got out at the close, and the open many times wasn't even the best price. Many times you open and then we were seeing intraday lows that were going even lower. I'm just saying you get in right at the open, you sell at the close, you make 18% on ISRG. ISRG net through yesterday's close was down 147 points from here, which is probably about 23%. So instead of being down 23%, you would have been up by 18%. The only difference is that you went to bed not worrying about where the market was going to open the next day. So if you wonder why I'm sitting in mostly cash overnight and have been for a while, this spreadsheet and the accumulation distribution hopefully helps to illustrate it. Now, could things change? Could we have another move down and all of a sudden we're gapping up at the opens and selling off during the day? I mean, it could happen. I can't imagine in this market environment that everybody's just going to want to start jumping in and watching everything sell off all day long and then jump in again the next day and watch. I mean, that doesn't really make a whole lot of sense. I think we're going to see similar to what we've been seeing. I think if there's fear and panic, we're probably going to see more gap downs. And I'm going to continue to update this as we go forward because I think this is powerful. When you look at the spider since March 23rd, look at the during the day swings. We had 2 days where you would have lost $3 and $2. The other 6 days, or this ISRG, not the spider, I'm sorry. But ISRG, you could have lost $3 and $2 from the opening price. But the other 6 days, they were all double-digit dollar gains. So on a $400, $500 stock, we're talking at least 2%. And in some cases, this $38, this would be, I don't know, 7, 8, 9%. Off of the 462, $38, yeah, that's probably about 8, 8.5%. It's a pretty big return in one day. So there are opportunities out here. Now, what I'm doing is I'm trying to find good sectors, leading sectors. I'm trying to find leading stocks within those sectors. And I'm trying to find rising accumulation distribution. Those are the 3 pillars that make me feel really good about a stock in this environment right now. Not that we can't lose money, not that it can't go lower, but I feel better trading a stock like ISRG than I do trading Delta Airlines. Because for whatever reason, Wall Street is evaluating these companies, and Wall Street is absolutely just throwing, Wall Street's looking at Delta Airlines like it's a dumpster fire and looking at ISRG like it's the promised land. And if that's the way Wall Street is investing its money, then we should probably be thinking about doing the same thing. So while everybody else is panicking at the open when the market goes down, ISRG and others, many others like this stock, when they're gapping down because the overall market is gapping down, many times these are the companies that are presenting the opportunities for day traders. And I've done a lot more day trading. I'm not a day trader generally. I like to position trade, swing trade. I like to hold in a solid market, a good uptrending market, VIX down around 10 or 11. I like to hold for 2 or 3 weeks, make my 10, 12% on a trade and get the heck out, not worrying about what the headlines are going to be in the morning because the market's not fearful. That's my kind of trading environment, my strategy. But that will not work in this environment. And if you don't recognize that as a trader and you don't change your strategies, you're going to have difficulties, in my opinion. And maybe I'm wrong. Maybe there's some of you that can continue to trade, swing trade, and do it perfectly. But I am having problems. And maybe some of you are just saying, hey, you know what? I'm just staying on the short side. I'm doing well because I'm shorting. Well, based on this, you might want to get out the open. If you are shorting, and this is a big risk, because what if news comes out overnight that something positive happened? But this whole strategy and all of this research tells me that if I'm going to short, I really want to be in overnight. I mean, it's a gamble, but that's where most of the selling is taking place. So it doesn't matter if you're on the long or short side. I think you can gain a lot from what's taking place in the market right now. Okay, what else do we have here? So hopefully that explains a little bit about the accumulation distribution line, the on-balance volume, the disparity between the two, and how accumulation distribution can help us as we go forward. I don't know if you've noticed, but I pretty much have just gotten rid of RSI off my charts. I'll bring it back at some point. But right now, to me, accumulation distribution is much more important than RSI. I'm not going to buy a stock. I'm not going to buy a stock just because the RSI goes down to 11. Or I'm not going to sell just because it's at 42. This market is way too volatile. And I don't find, I think that the RSI and stochastics, I think they're much better in a very structured uptrend or downtrend. I think this massive volatility overrules many technical indicators. I just think that they're useless in an environment like this. I can't find a good use for them. They don't make sense to me. Looking at and then what's really going to not make sense to me, and this is going to be coming out. Let me show you. You're going to hear this, and I'm just going to give you my take on it. I may be wrong, but I think I'm right. Eventually, what we're going to see, take a look at the spider. Let me pull up the RSI, because this is what we're going to see soon. You see at the end of February, the RSI went down to 20, maybe a little less than 20. I think on the next low, if we get back down there, and maybe I could even bring up stochastics as well. And stochastics is even worse in terms, I'm talking about positive divergences. Okay, so let's shorten this down just a little bit. I want to annotate something for you. So back at the end of February, you see how stochastics and RSI were very, very oversold. That basically occurred right about there. And you know, a lot of times, excuse me, a lot of times after you bounce and then you go back down, you put in a new price low, like right here. You look at momentum indicators and you say, wow, we got positive divergences. See how we put in a new low here and we have higher RSI and higher stochastics? A lot of folks would say, there's positive divergence. I'm jumping in. This is the bottom. Well, we got one day and then right back down to new lows. Would have gotten absolutely killed based on using that as your strategy. And with each one of these new lows coming down, look at the RSI and stochastics. We never went down and put in a lower low. So every one of these lows would have told you to get in. Positive divergence, positive divergence, positive divergence, positive divergence, all the way to the bottom. Oh, finally, it worked. How much money would you have lost trying to figure that one out? Look at the PPO. PPO didn't put in a higher low. I think it will on the next one. I think the next one, I think when the next positive divergence prints, I think the PPO could be giving us a pretty good signal that I would rely on much more than stochastics and RSI. The thing that I never understand about RSI and stochastics, especially stochastics, is when you get down to 2 or 3 on stochastics, you're bound on stochastics 0 to 100. If you get down to 0, 1, 2, well, guess what? You can't put in a lower reading. So it doesn't matter whether you go lower or not in price. You're guaranteed to have a positive divergence. What the heck does that tell you? To me, that tells me nothing. I mean, if you know anything about RSI, getting an RSI down below 20 is really hard. RSI is bound by 0 and 100, but rarely do you see RSI go down to 0 or anywhere close. I mean, if it gets down below 10, that is rarefied air. Or maybe rarefied underground. Rarefied air would be above 90. That doesn't happen very often, but using divergences on RSI and stochastics, I think, is the most useless form of divergences in the history of technical analysis. And that probably doesn't tell you strong enough how I feel about it. I think it's a waste. Just, again, you can't go below some of these levels. So a lot of times when prices go lower and you have the higher higher RSI and higher stochastics, well, it can't go below it. So to me, it's much more practical to use the PPO because number one, the PPO, in theory, it's bounded, but it's not really. I mean, you've got to get to a point where momentum slows. Momentum, you can see after a little bit of a bounce, momentum was not slowing. When we kept going lower, momentum was not slowing all the way until we got the bottom and finally put in a more extended move to the upside. Now we've got momentum slowing. If we get back down there to the 220 area, I think you're probably going to see a higher spider PPO. And if we can get some kind of reversing candle with a lower low, that could be the ultimate bottom. That's one of the things I'll be looking for in the market if we go back down. Now, as I said earlier, I'm adjusting on the fly. What if we don't go down to a new bottom? We've got to be prepared to look at what is significant back to the upside. I think there are a couple of things. Number one, those Fibonacci levels that I already talked about. If we start to move through 50%, that's going to, with this kind of a panic move, it's unusual to get back to 61.8. 50%, if we go through 50% of that down move, that's going to start to paint a much more bullish picture, in my opinion. Watching for a close over that 50% level. The other thing I'm going to be watching is where is the money rotating to on that move? If we go up to the 50% level, but utilities and real estate are leading the market, not going to be overly impressed. But if we've got technology, consumer discretionary, communication services, financial start to rebound, the 10-year treasury yields moving up, all of those things start to come together, then I'm going to be much more inclined to believe in the rally. This, reviewing the market is a puzzle. You got to put a lot of pieces together. It's not, oh, the RSI has a positive divergence. That means we're at a bottom. If you're taking the market that literal, technical analysis that literal, I think you're making a big mistake. Like I said, we kept going down, down, down. Look, the RSI never got back down to where we were at that level, or stochastics, both of them. Every one of those gave you false signals. Be careful. All right, what else do we want to go over here? All right, let's get into some charts. I know probably a lot of you are thinking about that. Before I get into the charts, let's go ahead and take a look quick at what the market's doing. Well, we're seeing more acceleration now to the downside. Dow Jones down 339, S&P 500 down 36, NASDAQ down 97. I would say this, and I'll say this at the risk of things being green an hour from now. I think the path of least resistance is to the downside. Just based on history, based on the fear levels, based on everything that we're going through, I think that there is an opportunity for professionals to have even a better opportunity to accumulate. And I think they will, at the expense of a lot of folks who are panicking out of this market, unfortunately. I have said before, I would say it again, if you're a long-term investor, you can't just be a long-term investor when the market's at its high or when it's 10% off its high. You need to be a long-term investor all the time. It's when you're going through the ups and the downs. You don't care because you've got a long-term goal. You only care about the end point. You don't care about all the intra-period points in between, the huge ups, the huge downs. So many people that I know tell me, well, I don't really pay attention to the market. I just put my money in my 401k. Yet when we get this period, then they're the first ones that want to know, should I get out? And I just kind of scratch my head and I'm like, you're not a long-term investor. If that's your thinking, then you need to be thinking more in terms of exiting when some of the warning signs come up to protect yourself against the downside. That's different than being a long-term investor. That's being more like a trader. Whether you want to, you don't have to, some people look at trading and they say, oh, well, I don't want to, buy Apple every day, in and out, in and out, in and out. There's lots of different ways you can trade. You can trade much more infrequently. You can trade ETFs instead of stocks. You can, there's so many, mutual funds that are designed to follow the benchmark indexes like the S&P 500. But that doesn't mean you necessarily have to hold the S&P 500 when it starts to fall apart. I mean, think back to February 26th, 27th. I mean, if you took that approach that when the 5-day moving average of the VIX hits 20, I'm just moving to the sidelines, maybe back test it. Say, well, when that 5-day moving average comes back down below 20, I get back in. See if it makes a difference. I don't know. I've never done the study. Or maybe you say if it, goes to this point, if it breaks a support level and the VIX, that 5-day moving average goes above 20, I'm getting out. If price comes back up above that support level I just lost, I'll get back in. Otherwise, I'm going to let it go and maybe set a target. I don't know, 10. If it drops 10%, I'm going to start getting back in, maybe a third at a time, 10%, 10%, 10%. I don't know, something. That's different than buy and hold. So first thing everybody has to understand is what kind of a trader you are. If you're long-term, I would be sleeping like a baby at night, not worrying about this because you're long-term. Stock market history tells us we're going to bounce back from this. And I can promise you our government and the Federal Reserve is going to throw everything it has at it so that we rebound and so that the recovery is a very, very quick one. And again, as I said at the opening, perhaps the most important part of this is that we went into this pandemic with an extremely strong economy, which I am very thankful for. This 12 years ago, on top of the financial crisis probably would have set us into a Great Depression, maybe even worse than the one we had back in the late 20s and early 30s, because we already had a system ready to collapse. And now imagine this going on top of it. But fortunately, we weren't in that position. All right. All right. Charts. Now, let me just pull up a chart and then we'll go in. So first thing I want to do is introduce those of you out there who are not familiar with the Strong Earnings chart list that I do. So prior to all of this happening, I went through and for our members was constantly updating this Strong Earnings chart list. The whole idea and concept here at Earnings Beats. Hold on one second. Let me get a drink of water. The whole idea and concept here at Earnings Beats is we're combining fundamentals and technicals. Fundamentals being earnings. My background, again, practicing as a CPA, I know a lot about the fundamental side. I used to basically do financial statements. They're technically owned by the client, but in practice, many CPA firms do the financial statements. I know all the basic fundamentals, the price earnings ratio, book value, sales growth, earnings growth, price earnings growth, all of these different things that we can talk about. I'm familiar with them. What I bring to Earnings Beats and hopefully to our community is the combination of earnings and technicals, because earnings, there's nothing really that drives stock prices more than earnings. I mean, if your earnings are going up, your company's going to be more valuable. If they're going down, your company's going to be less valuable. And what I've found through the years is that there are management teams that tell Wall Street that they're going to do certain things. And when Wall Street has a history of believing those management teams, like Apple, when Apple comes out and gives you a forecast, it is rare when they miss that forecast. Very, very rare. Wall Street knows that. And they also know that Apple is very conservative. So when they give you projections, chances are they're going to beat them. So when you start putting together valuation models on a company like Apple, you're going to err a lot of times to the upside. You're willing to pay more. You're willing to value Apple more because you trust the management team, you trust their products, you understand their business model, it works. The more companies that we can invest in that are like Apple, the better chance we have to make money. So the whole concept of a Strong Earnings chart list is to go back, look at companies in their most recent quarter, and find out who is beating their estimates on both revenues and earnings, because that's a good indication that management is executing its business plan. Now, some companies will beat earnings one quarter and miss them the next, beat them the next, miss them the next. And so some companies, if I like the chart and they beat earnings, they'll go on our list, but then we get rid of them before we take them off of our chart list, before they report their next earnings. And then we evaluate again. How did the earnings come out? Did they beat? What's the chart look like? Is the company liquid? Do they trade enough shares for us to put it on a chart list and send it to our members? All of those things go in, and then that's how we constantly develop this chart list. Now, I number all of the charts, and basically the numbering coincides with the chronological order in which these companies are reporting earnings. So I can tell you that STT is a company that reported their earnings all the way back in probably late January, because any companies that reported in the first 3 or 4 weeks of January, I have deleted from this list now, because they're going to be reporting earnings the next few weeks. But STT reported probably back toward the end of January. And so in another couple of weeks, I'll be removing this from the list as we get closer to their earnings date. But all of these are in chronological order. So the ones here with the lowest numbers in this chart list are companies that reported the longest time ago and will be coming up for earnings sooner. And if we go to the bottom of this list, I actually have just updated it, added 13 new companies since the last time everyone got this list. All of our members got this list. So VIPS is the last one on the list that you have probably, members. I've added DQ through Lululemon. So those are 13 that have been added. But I have gone through, this is what I've been doing this week. I looked at every one of these charts. There were 380 of them on here. And weeded out the ones that I thought looked bad from an accumulation distribution standpoint. So now what I'm doing is I'm basically using the same criteria that we used before, but I'm adding one more filter, and that is accumulation distribution. A lot of the companies that we had on this list prior, I want you to think about companies like, I think Norwegian Cruise Lines was on the list. Delta Airlines was on the list. A number of airlines were on the list. 2 months ago, a month ago, 6 weeks ago, they deserve to be on the list. They beat earnings. They look good on their charts, and that's what we want to consider. Now, because of everything that's happened, we know that there is a change that has taken place. This isn't necessarily and probably not likely to be a very short-term change. This is going to be a change that is going to take a while. I don't know how the bailouts are going to fare going forward. I don't know if airlines, I imagine they're going to be bailed out. They're going to need it probably. Cruise lines, there's a lot of debate whether cruise lines would be bailed out because many of them don't pay taxes in the U.S. They've been, registered offshore somewhere. And so now there's a big argument, do you bail out companies that aren't even paying taxes to the U.S.? That's going to be a really difficult debate. I don't know how all that's going to play out. I just know I don't want to be part of airlines. And I don't want to be part of cruise lines. There's too much uncertainty. And I want to show you something. This is the STT chart. Here, look at the accumulation distribution rising to a new high off that February 19th low. And then among asset managers, it's been going down. Asset managers, not the best group, although we have seen relative strength in asset managers over the last month or so, maybe last 3 to 4 weeks. So this one was probably more borderline. This isn't going to be the best one on this list for sure, but it's one that I'm okay with. It's better than breaking back to new lows on the accumulation distribution. But let me show you something that doesn't look so good. Let's look at Delta Airlines. Now here you can see the big drop, the rally and the drop, but do you notice the difference in the accumulation distribution? This is probably very similar to what we saw in OBV. This is where, do you see many hollow candles here? I see almost all filled candles. So not only are you seeing big gap downs, but you're also seeing selling throughout the day. That's the difference between Delta Airlines and some of the other stocks I'm going to show you. Delta Airlines has got some problems. All the airlines have some problems. There might be some that look a little bit better than others, but it's really the old lipstick on a pig kind of analogy. They all are pigs right now. I hate to say that. And, we need airlines. And I hope for the sake of all people that are employed there that, the government makes all the right decisions. They do get bailed out. I think this is really important for our economy going forward. So I'm not trying to make any light of the situation that the airlines are in. I'm just strictly talking about from an investing perspective. Delta Airlines and all of the airlines is not where I want to have my money going. And the accumulation distribution confirms the huge drop in price. And I don't think they're done going down. If you remember, and you've been getting a daily market report, I'm not somebody that talks too much about shorting because it's just not my strategy. If I believe we're in a secular bull market, I don't want to be shorting because if I'm wrong and the market starts to turn back up in that secular bull market, and I called the bull market and I'm losing money because I'm going short, that is something emotionally that I have problems with. So I just would rather sit out. To me, I'm making money if I'm not trading and the market's going lower. But, I sent out an email recently and asked members to respond back to me if you short or, what's your strategy, maybe leveraged ETFs, inverse ETFs. And I got back a fair number. I mean, still a very, small number of our members like to short, or at least a small number responded to me. But it was still enough people that I thought, hey, you know what? We need to take a look at this from the short side. And I don't know if you remember, but a couple of, maybe several days ago, 3 or 4 days ago, I put a couple of stocks in. One was Unum. And the reason that I would consider, and this was back when it was near the high, actually it might have been after this first red candle. I think it was before the gap down. So I'm guessing it went out on Tuesday, looking at this chart. But look at the accumulation distribution on Unum. So here was the accumulation distribution in February. It has not gone higher, and it continues to drift lower. So this is one that I think has been a problem. And if we pull it up on a relative chart, you can see that not only was the accumulation distribution weak, but this is a stock that's very weak versus its life insurance peers, and its peers are weak versus the S&P. So you have one of the worst groups, one of the worst stocks within the groups, and also accumulation distribution, which is declining. If I'm going to short, those are the kinds of stocks I want to short, especially if I could get them on a little bit of a rally. Like today, anything back up near that 14 level, you can keep a pretty tight stop. If the market goes down, I doubt that this is a company that's going to go roaring straight back up. I mean, there's no signs of that here on the chart to me. So this is a stock that I would be interested in shorting. And we did have some hollow candles, not many on the way down. We did have some hollow candles on the way back up, but I swear I think a lot of this has to do with option expiration and the week after option expiration. That's where the market historically, again, if you follow me, you know, 19th to the 25th of a calendar month is when the market historically does its worst. That's when it performs its worst. All calendar months from the 19th to the 25th, although December is a little bit of an exception. I think November might be a little bit of an exception, but most months, 19th to the 25th. And that's usually because the market's going up into options expiration, and then we see a pullback. Well, in this case, we were seeing the opposite. We saw it go down into option expiration, and then the rally. Next up, how about something like Wells Fargo? Another one. Look at the, well, here you can see banks going down. Wells Fargo relative to banks going down. So you've got all of these relative lines going down, so you know you got a loser. Here, the price action's been horrible. And so you got to bounce, by the way, up near the 20-day. And now if I pull up accumulation distribution, look at the accumulation distribution. You see the difference between this? I talked about ISRG earlier. Let me show you ISRG. See the difference in the accumulation distribution? Do you see how almost every one of these candles are hollow candles, meaning that you're closing above the open? That's how that $100,000 example went to $118,000, because you're getting in at the bottom of these hollow rectangles and you're getting out at the top of the hollow rectangle. Only, I'm going to say there were probably since February 19th, maybe 1, 2, maybe 4 or 5 decently down days during the day. Everything else, you really wouldn't lose much money on ISRG simply by buying at the open. Now today, it opened a little bit down and it's down. So this would be a candidate to me, simply because, and what I might do is hope that this stock goes down and takes out yesterday's low. So let's pull up a 10-minute 5-day chart. If we can go back down and go a little bit below 450, let's say we go to 446, and then you see it rally back. Actually getting a little bit of a rally right now. But let's say it rallies back from 446 and gets back up above these prior lows, 451. I could maybe think about getting into a position at that point, knowing that when we go to the daily chart, most of these candles are hollow. If I get in at 451, I'm going to have a pretty big red candle at that point, red-filled candle. And I know by the end of the day, we don't see too many of those. So I could get in at 451, put my stop in at 445, just below that earlier low, and I might get stopped out. That's 1% that I'm going to risk. And if I take a small position, no commissions in this environment, 1% of a small position is probably won't amount to too much. But what if we get one of these big hollow candles where we rise back $30? $30 to the upside versus $5 to the downside sounds like it's a pretty good deal. And again, I know from at least this brief recent history that this is one of those stocks that's being accumulated. So I think ISRG is the type of stock that I would be very interested in trading. All right, so if you go through the entire Strong Earnings chart list, and so let me pull that back up again for you. So you literally, if you have this in your account, you could go through every individual chart if you want. But if you already have this in your account, why not just hit View All, Summary, and there's the stocks that are down. Now keep in mind, again, these are companies that have histories of strong candle bodies, mostly hollow candle bodies, and also have a history of strong accumulation distribution, and they're mostly leaders. So when you can get an opportunity to get some of these lower on the day, it might make sense. The other thing you could do is they all have well, not all of them, but some of them have scooter scores. Most of them have scooter scores. The other thing, instead of looking at it from a how much are they down today standpoint, is what about the scooter? Can I find any of the best companies out there that are getting hit pretty hard today? Well, here's VIPS. It's a broadline retailer which has done very well in this market. 99 scooter rank, $14.23. It's down 5% today. That's one I would say, hey, let's take a look. Maybe we got something here. Well, when we look at it, it's showing a pretty big red candle. When I look at the accumulation distribution, I'm at a new high. Now, this reading doesn't add in today. So this red candle that we're seeing today, we don't know where it is at the end of the day. But we have seen tails to the downside on many days before and gone back up by the end of the day to finish higher. So I think this is a potential trading candidate. Now, we might look back and say, it's put in a lower low. Maybe we wait and see if it gets back up above yesterday's low. So here was yesterday's low. Maybe if it gets back up to 1443 or something, maybe we ride, or maybe we take a shot at the current level, small position, knowing that the longer term, I'll go out to an hourly chart, we've got some pretty good support around 14. So maybe 1423, small position. We only risk maybe to the below these lows, or maybe even we add. Maybe if you have a really small position, you get down to 1390, you take a second shot and add. You still have a pretty small position, but now your average entry is maybe 1410, something like that. And then you decide, okay, how much room do I want to give this? Maybe it's 3%, maybe it's 5%, whatever it is. Put your stop in. And if it goes down, you get stopped out. But if it rallies and starts to move back up into this uptrend like we saw a few days ago, you could have a pretty nice trade. So these are the types of opportunities that I believe will present themselves within our strong earnings chart list. So again, I just want to point out to everybody, if you look and we sort this by name or number, you can see there's going to be a lot of skipped, because what I did is I went through every single one of these. It was painstaking, but I went through every single one of these charts and I deleted them one at a time if I didn't like the accumulation distribution, or if I didn't like the complete deterioration in relative strength. I mean, airlines, think airlines. Even airlines, for the most part, do have weak accumulation distribution. But if a stock is really performing poorly versus its peers, but still has a decent accumulation distribution, I still took it off. I'm trying to find some of the best of the best. So ISRG was one. A stock like TDY, this one's very interesting to me. It's up today. I'm not shocked. It was down at the open, and now right now it's up $5 from its opening price. But if you look at the stock, look at it rebounding. Look at its accumulation distribution moving up. And look at it relative to aerospace. Aerospace has been getting killed, mostly because of Boeing. But this has been a strong stock within aerospace. And you can see, look at all these hollow candles. It did have two big red-filled candles, but outside of that, there really haven't been any. Maybe this one looks like maybe a $10 move to the downside, but there have been a lot of hollow candles. Look at the gap down yesterday. Stock was down as low. See, this is the strategy I was talking about. So let's pull this 10-minute, 5-day chart up. Yesterday, so we're in this downtrend. The stock opens lower. Remember, many of these stocks rebound after opening lower. We open lower. When we get back through the prior day's low, so we went down, when you get back up to, say, 274, you buy. And then you decide, maybe if it goes below 270, you want to get out. Might be a quick in and out. You might lose a little bit of money. But what if it follows its recent history and it continues to be accumulated during the day? In this case, it did. You could have gotten into the stock around 274, and 30, 45 minutes later, it was 288 and change. Those are trading opportunities that this strategy and the way the market's been operating, these are some of the ways that I would be thinking about approaching the short term from a long perspective. Now, a short perspective, bring up that on Wells Fargo. We're up here trying to challenge the recent high. Well, that's the time I would think about shorting. And you can see Wells Fargo back down. It's down probably 75 cents from where it was earlier, maybe well, more than that, maybe close to $1. Yeah, almost $1 from its high. So those that aren't doing well, I would just reverse the strategy. And when you're getting up close to a prior high, or if you do break out to a new high and come back down and lose that breakout, maybe it's time to get in on a short. But I think these create some opportunities for all of us. All right, so where to trade? You know, I've got the strong earnings chart list, but what areas? What should we be looking for? And let's get a quick update market. Still moving a little bit lower here. Dow down 400 points, NASDAQ down 115, S&P down 43, back below 2,500. I go into the sector summary, and I look at over the last month. And look at what, I mean, these three groups really are the ones that I focus on. I'd maybe even throw communication services in. We know over the last month, the market's been down a lot, probably 20% or more. I don't know what the net is over the last 30 days, but probably 20%. You can see healthcare down 8%, consumer staples 8.9, technology 13.8, and communication services down 16.9. They are outperforming the S&P. So when we get these gap downs, guess where money is going? Money's going into these areas. That's why we're outperforming. Individually, healthcare, you go into healthcare, pharmas and biotechs. I love biotechs. I didn't realize this until I pulled it up a couple of days ago. Pharmas were actually outperforming biotechs, but I knew biotechs had been strong. And in fact, in today's Earnings Beats Digest newsletter, I wrote a very, very brief article. I'm just trying to get ready for this webinar, so I apologize for how brief it was. But when you look at the biotechs and you compare it to the S&P 500, and go back a couple years, and you look at where we are, this is pretty strong. So throughout this whole debacle, I think it's pretty clear Wall Street is saying you really need to own biotechs. And fortunately, I think we do have biotechs in our 4 portfolios. A couple of them doing really well. And one that I've touted and talked about a lot, I wish, you know, it was close to putting it into one of the portfolios, ended up not putting it in. It's been one of the better ones, which is REGN. But let me show you what REGN has done. Now, it's accumulation distribution just breaking out again. It broke out in early March. We went through all of this sideways action, now trying to make a breakout above 500, which would be incredibly bullish with the market selling off. I mean, look at it today. It's down $2, half of 1%, much better than the overall market. It's at resistance, so selling it here wouldn't be a bad strategy, but I think it's just a matter of time before we get a stock like this it breaks out. And you look at it on a relative basis. Relative to the biotechs, it's one of the leaders. Relative to the S&P, one of the leaders. Biotechs versus the S&P, it's a leader. This is how I break down. This is how I begin to look for the stocks I want. Strong stocks in strong industry groups with strong accumulation distribution. And then when I see weakness, that's when I know, based on everything that's happening in the market right now, I can't know for sure that's what's going to continue to happen. But really what we do with technical analysis is we're always reviewing the history to predict the future. And that's exactly what we're doing here based on this new paradigm shift and this new strategy that I've discussed, that I've researched. I think this is an opportunity in the short term. I'm not talking about this being something we're going to do for the next 20 years. I think in the short term, this is a really important piece of this puzzle as a trader. So really, bottom line is, what can we do to try to find some stocks? Let's say, you know, you don't want to deal with the Strong Earnings chart list. You're just out there on your own. You're not even going to contemplate joining us at Earnings Beats. I wish you would, but I know some of you won't. One thing that you can do is I'm going to show you how to develop a scan using the accumulation distribution, where it was several days ago versus where it was back near the market top. And in order to kind of show you how you can write the language, sometimes I don't know how to write the language. So what I'll do is I'll go into predefined scans. This is going to be the last thing we go over, by the way. So we should be out of here at noon. When I go into the bullish MACD crossovers, I know kind of how they're going to have to write that scan. And I want to draw, I want to run a scan against New York Stock Exchange. So I just go in here under NYSE and pull this up. And up here at the top, it'll say, click here to edit the scan. This will show you how the scan is written to get this particular predefined scan, which I find very helpful because then it begins to give me ideas of how I can set up my own scans. So when you do this, you see how it's type equals stock. Okay, I want that. Type or exchange equals NYSE. I just said I want that. 20-day moving average of volume greater than 40,000. I don't know. Maybe I want to change that. Let's go 50 days and let's make it 200,000. I mean, I want a little more volume. And then I'm not really interested in the MACD, so I'm going to get rid of all this because all that's doing is just comparing MACDs. But one thing to notice before I do take it away, you see how it's saying the MACD line, 2 days ago, 3 days ago. That's the language you want to use in front of these different technical signals or technical indicators. Hold on one sec. I can tell we're getting close to the end because my throat's getting dry and I need my water. But just keep in mind this 2 day, 3 day ago in the language and how you put that in there because that's pretty important. But let's get rid of all this because I'm going to set up a scan that really focuses just on accumulation distribution first. So how do you do that? Well, if you go down here, technical indicators, look for that AD line or accumulation distribution. There it is. So I'm going to add that and it comes up and the default is the accumulation distribution is greater than yesterday's. Well, the problem is I can tell you if I'm going to check syntax, make sure it's good. Okay, we're good to go. I guarantee you that the result is 0. Let's see what we got. The result is 0. Now, does this mean that the accumulation distribution today, that there's no stock in the market that has a higher accumulation than yesterday? That doesn't seem possible, right? Let's go back here. Nope, that's not what I wanted to do. Where was I? Oh, there we go. I just got off the wrong tab. Okay, so I know that there are accumulation distributions going to be higher, but this is one of the things you have to understand because I couldn't quite figure out for a while why my scans kept returning 0 results. But here's why it returned 0 results, because accumulation distribution hasn't been calculated today yet. So there's no reading today versus yesterday. So what we need to do is we need to go back in and change. Now what I did is I want to go back and look at the S&P 500. So let's go back and I want to count the days. So yesterday would be 1 day ago. So I'm going to go 1 day, 2 days, 3 days, 4 days, 5 days, 6 days, 7 days, 8 days, 9 days. 9 days ago was the low. Now I'm not going to go through the whole thing here with you, but the high was 32 days ago. So I actually had already done this scan over here where I put in here 9 days ago, accumulation distribution was greater than 32 days ago. And what this is going to do is it's going to tell me after that huge decline, how many of these, how many New York Stock Exchange companies actually show a higher accumulation distribution. And then I went a step further and said, and give me the group healthcare, because that's been the best performing group. And all you have to do there is go down here under the sectors and just pull up healthcare. So I would go in here and I literally would just click on this and hit add, which I've already done. And that's why it shows up here. You check your syntax and then you run the scan. And there's 51. Just ran it as of 11:54. So now there's 51. So now I can go ahead and I can store these. Now I'm going to replace an existing chart list. I'm going to replace it into my, usually I have a scan results. Oh, here we go. I'll just put it into scan results other folder. And there they are. Now what I can do is begin to pull these up on a 10 per page. And there's my accumulation distribution. So now what it's doing is it's looking back to March 23rd, which is here's where the AD line was, versus February 19th. So it was higher. That's why this stock was put on this list. So Agilent, is this one that I want to consider? Maybe. I just showed you how I can find healthcare stocks, the best sector, how I can find 51 possible trading candidates that are all showing higher accumulation distribution than where we were. Here's another one, ABBV. And you can see a lot of hollow candles, couple of big red candles. I mean, you can get caught to the downside, which is why I think you have to keep your stops in play. But more often than not, we have hollow candles, meaning that if you get the stock during the day when it's down, you have a better than 50-50 chance that it's going to come back and go positive based on the way it's been trading. ABC, still pretty good accumulation distribution. Now here, Abbott has actually been coming back down. So this one has got a little bit more in terms of filled candles. If I got in, I'd have to make sure my stop was tight, keep my stop in play. This one doesn't look as good. I'd rather have ones that keep going higher. Allergen, this one's higher, but it's not exactly flying to the upside like many of the others. So this one I'd be careful. Alcon, now this one looks really good. Look at all of the hollow candles here. Very few red candles. So what does that mean? Well, earlier today it was down. The stock market's selling off. Alcon's being bought back. So this is what let's pull this one up specifically, and let's pull up a 5-day or 10-minute 5-day chart. See when it went negative? That was an opportunity. Now you could trade it, I don't know, maybe when it gets to 49.40, maybe you have a second entry at 48.90, maybe even a third entry at 48.25, you know, in the event that it sells off, and then maybe keep a stop below that. So you might only get 1/3 of your entry. But hey, if it goes higher and you don't have commissions, even if you're getting 10 shares, you know, 10 shares goes up $1, you make $10. I know that doesn't seem like much, but it's kind of a far-fetched example. Most of us probably are not going to trade 10 shares of a $49 stock. That'd be $400, $500. But hopefully you see my point. When you get stocks that are showing what ALC is showing, then you know you've got an opportunity to trade. And if you build a list, and one thing I haven't done yet, I'm going to work on over the weekend, is I want to go through and analyze all 51 of these healthcare stocks, maybe trim the list to maybe my top 15 or 10 or 15, and then do that with all the sectors, and then put them all in one chart list, which is going to be an accumulation distribution chart list that I'm going to make available to all of our members, just like the Strong Earnings ChartList. So that you'll have to look forward to. And I'll be working on that this weekend. But anyway, it is 11:59. I am going to close this up now. Did go 2 hours. I know it was a long one. We've had some people drift out of here. Hopefully they'll go back and look at the recordings later. But if you're a non-member, I just want to again reach out to you. Please, give us a shot. $7. It's refundable. Let us help you for the next 30 days. I hope you found some of this enlightening, maybe things that you didn't realize were happening in the market. But we're going to have these war rooms. As long as this battle keeps going on in the stock market, we're going to have our war room open on Fridays. I can't promise every Friday, but at this point, I don't have anything else planned. I plan to be here as long as I'm sitting in here, social distancing and, trying to remain safe and keep everybody else safe. Why not come in here and talk about the market? I'm going to be looking at it anyway. So that's my thinking. But go in and make sure you check out the $7 trial. We'll refund you the $7. We can't make it any less painful than that. $0 for 30 days to see, come in here for the next 4 weeks, see if this works for you.
Okay. Hey, great job, Tom. I'll make sure everybody gets to see presentation the next day or so. And I'll be back here next Friday.
Sounds good. Everybody have a great day out there. Please be safe. Again, thanks to all our healthcare workers out there. I know you're doing a fantastic job. Praying for you every day. And hopefully we'll get to the end of this all together. And we'll get back to normal. But for now, we'll, continue to do this as a community. So everybody have a great day. Enjoy your weekend and see you next week. Take care.